All right, let's go ahead and get started. Today is Monday, November 4th. This is being recorded. Got a few things we want to accomplish today. First, I want to start with a quick check-in on the Bloomberg Trading Challenge. My screen here. All right, so let's look at Bloomberg. And this is section 201. Here's where we stand as of today. All right, the good news, everyone in the sections made at least their 10 longs for the second half of the semester. Everyone is below $300,000 worth of cash. Make sure you stay there for the rest of the semester. And if the simulation were to end today based on portfolio value, here's where we stand. And what you'll notice, market's been much tougher. A lot of tech stocks are down. Most companies are actually losing money at this point. Matter of fact, that the team that's doing best seems to be breaking even. But that's just kind of a snapshot of where we are. A little bit different market than in the first half of the semester when everything was kind of going straight up. It's hard to make money in that market. That's probably what's reflective of these results so far. All right, this is just a snapshot. Where you end up at the beginning of December is more important, but just wanted with a month to go, kind of check in and see how we're doing. Questions about the trading challenge? All right, last Wednesday, you did a midterm exam. So I wanted to go over the midterm exam solution. The solution file, or basically the results have been posted. Assignments, midterm. So very quickly, I checked in on an earlier class on the quiz statistics, and the average person got about 9 out of 10 correct on the midterm exam. The lowest score was 4 out of 10. Most people did pretty well on the midterm. Overall, remember, you need a 6 out of 10 on the midterm to opt out of the final exam. So if you got a 4 or 5 out of the midterm, you were taking the final exam. Okay. So in terms of questions, let's talk about the answers to the questions of the midterm. Was there a question over there? Okay. All right, so first question of the midterm. If the CFI and TII do not balance, you're likely missing an item from which statement? Well, we know that the income statement drives the TII, and so therefore, if there's a problem with the TII, it would be coming from the income statement, and therefore it would cause a problem with CFI. So the answer would be the income statement. Okay. All right, question 2. Which of the following is not part of the key value drivers formula? This was a gimme. You literally could, an open book exam, look at the formula. It's in a lot of different PowerPoint slides. It's in the book every place. Key value driver formula. What is not part of it is invested capital. Okay, so that would be not part of the formula. Question 3. Which of the following is not part of operating working capital? We know, as we have separated out in Modigliani-Miller, anything interest-bearing would not be part of current assets or current liabilities. So therefore, current portion of long-term debt is a 3. It is interest-bearing. It is not part of current liabilities, and therefore not part of working capital. And so in this case, that would be the answer, current portion of long-term debt. Which of the following would be a reason to decrease the payout rate? Well, this was a question that tested the idea that the payout rate and the reinvestment rate have to add up to 100%. Okay, kind of knew that from earlier. So if you are decreasing your payout rate, you're increasing your reinvestments. So really the question is, why would you increase your reinvestment? And the answer is because you got a positive spread, right? Because you have a positive spread, it makes more sense to reinvest rather than to pay out. So the answer would be ROIC greater than the WACC, all right? The cash flow is a little bit of a red herring. because you could technically have negative cash flow and a positive spread. Maybe you're just spending money now to make money later. So the cash flow doesn't give you an answer to that one. It's kind of the result of the spreads, but nonetheless, the answer would be on the spread. Question 5, which of the two companies would trade at a higher multiple? Again, you could have plugged these right into the key value driver template that we've used earlier this semester. And we know that if you change the profit or the net income, nothing changes about the multiples. Okay, so process elimination. Multiples are growth, return, risk, growth, and spread. So if you just plugged in the values, we would know that they would trade at equal multiples. They'd be the same. Okay, so the answer would be they would trade the same multiple. Question 6, which of the following would increase your CFI? Well, we know that if you decreased your other liabilities and paid them off, that would reduce cash and reduce your CFI. We know, same question, basically, if you reduce accounts payable, which is kind of like a liability, that you would reduce your CFI. If you increase your excess cash, we said metaphorically, you're putting money into savings, that is reducing your CFI. And if you bought more inventory, that would also reduce your CFI because you're increasing your investment. So by process of elimination, none of the answers listed. Question 7, what is the impact of free cash flow from a purchase of PP&E? Well, gross cash flow minus gross investment is free cash flow. Increasing PP&E / CapEx increases your gross investment, which reduces your free cash flow. So in this case, free cash flow goes down. Be the correct answer. Question 8, which of the following would lead to an increase in EV to EBIT multiple? Again, you could have just plugged in the key value drivers. You didn't need to really know what the multiples were. We know that a higher WACC leads to a lower multiple. So we know it's not that. We know a lower ROIC leads to a lower multiple. We know it can't be that, right? We know that a higher EBIT has no impact on the multiple. Profit doesn't impact multiple, same as the previous question. So the real question is, does the tax rate matter? Well, we know from the ROIC tree that if we have a lower tax rate, we're going to have a higher ROIC. And a higher ROIC would lead to a higher multiple. So the answer would be a lower tax rate. I'll put two things together there to figure that one out. Question 9, if you did an EIC analysis and expected the future spread to be higher, which of the following is likely to be true? Well, if the substitute threats are higher, you're probably not going to have better spreads. Okay. If the barriers to entries are lower, you're probably not going to have better spreads. More people are going to come in. If the buyers have power over you, it's going to be harder to make money. That's going to hurt your spread. If the supplier power is lower, well, if you're Walmart, you can dictate prices to your suppliers. You might make more margin and more spreads. So the answer would be the power of suppliers would be lower. And then finally, question 10, doing an ROIC tree analysis, which of the following would lead to an increase in ROIC over 5 years? Well, we know, same previous question, pay higher taxes, that's going to hurt your ROIC. Decrease your margins, going to hurt your ROIC. Increasing your invested capital sales is going to hurt your ROIC. So the process of elimination, none of the answers listed. Those were the 10 questions on the midterm. Any questions about the questions? Again, grades are posted, answers are posted. If you end up taking the final exam, it's going to look a lot like this midterm. Just FYI. All right. So the other thing is timeline. 1 week from today is your next group project presentation, and it's going to be on valuation. Okay. So what you're going to do, we'll talk about the company that we're going to value in a minute, but for the company that you value, you're going to turn in the 4 Excel models, the as is, the bull, the bear, and the target, right? You're going to have at least the 5 screenshots, and you're going to put those screenshots into a PowerPoint file, and you're going to turn that PowerPoint file. So make sure by 10 a.m. next Monday, one person on your team turns in the PowerPoint file with all the screenshots and the 4 Excel models, right? You're going to give a 10-minute presentation. Presentation is going to go through all 4 models, kind of like your last homework assignment. Here is our as is and the key assumptions we put in and why. Here is our bull and our bear and the key assumptions that we changed and why. Here is our target and the key assumptions that we changed and why. That leads to a buy, sell, hold recommendation for the company. Okay, that's basically what your presentation is going to be like. Important that you use numbers, important that you talk about it in the context of what's happening in the real world. So if you're doing your bull and your bear, don't just say the growth went up. Like, what's the reason you're saying the growth is going to be higher, right? So again, everything that you present has to be in the PowerPoint, right? You should have already realized by now that there's an advantage to going last, right? Because you can kind of see what the other teams did. And like, oh, we forgot to talk about that. Let's make sure we talk about that. Or, oh, maybe we need to talk more about this. So to kind of compensate for that, if it's not in the PowerPoint, I'm not giving you credit for it. All right. I'm not going to let you go to the Excel files. The Excel files had to be turned in. But you can't work off the Excel files. So make sure everything you want to talk about is in that presentation. What I'd recommend for each going through the 4 models, take a screenshot of the assumptions tab and the ratios tab, particularly the key ratios that you're changing. And that's the point. When you say, I changed these ratios, point to that in the screenshot, and then have a few bullets. This is why we changed each of the ratios that we changed to whatever we did. And so you kind of work through your 4 models that way in the PowerPoint. But again, 10 minutes, everybody's got to present over the course of the semester. So we might have some new people presenting this time, but regardless, those presentations are a week from today. Questions about any of that so far? All right. So your final question is, what company am I going to present? Here, we're going to do it a little bit differently. In just a second, I'm going to give you an industry. Okay. Based on that industry, you will choose 6 different companies. Each of you will present a different company valuation within the industry that I assign to you. Okay. You can't present the same company. So this one's going to be a little bit more interesting because we're going to learn a lot more about an industry than we are an individual company by doing valuations on 6 different companies within that industry. Each of the industries is different across the 4 sections. Okay. So for example, in the last 2 sections ago, they had hotel and travel companies. In the last section, they had software companies. Your section is going to do pharma and biotech. Okay. So those are the companies that you get to choose from, right? So I'm going to give you a couple of minutes here to talk amongst yourselves and figure out which pharma biotech that you want to present on, and then we'll select them, and then we'll record the 6 different companies. Right. So I'll give you a couple of minutes to kind of talk about it. Don't all rush up here yet. And then I'll ask you who you want to present on and do your work on in just a couple of minutes. So. All right, so let's go back and select our companies. So under people, fall teams, I'm going to start putting the company that you're choosing next to your team name. So who you guys had what, Lily? What team were you? Team 10? All right, so team 10 is going to do Eli Lilly. All right, who else? Yes. Team 9 is going to do Pfizer. Who else? Yes. Okay. That's the one you want to do. J&J. Team what? Team 12. Okay. So team 12 will do J&J. Yes. Team 8 is going to do Moderna. All right. Yes. We'll do Merck. All right. So team 11 is Merck. Okay. So I just need team 7. So you got to pick one. So the good news, you pretty much have anybody else. So while they're doing this, we got Moderna, Pfizer, Lilly, Merck, J&J, and AbbVie sounds great. All right, so team 7 will do AbbVie. All right, so here's the deal. I would strongly recommend getting the data by Wednesday. Okay? Because if there's a problem and you present it next week and there's an error in your data, you'll lose a substantial amount of points on your presentation. Okay, so you can't have any problems with your data, right? If you tell me on Wednesday, oh, AbbVie is going to be problematic and we really want to change, you can change on Wednesday. Past Wednesday, not going to let you change. So email me on Friday and say, oh, AbbVie doesn't work. Can we change? No, I'm going to say figure it out. Okay, so my recommendation is if you really need to change by Wednesday. Otherwise, these are locked in for next Monday. Okay, questions about that? All right, so if you want to return to your seats, I want to talk about the data in the context of your latest homework, which you did on Starbucks. All right, so as part of your last homework assignment, you would have had to export data on Starbucks. So what you would have done for that or any other company change this to sharing my desktop. All right, you'd have gone to Bloomberg. You'd have gone to SBucks, US Equity, FA, Custom. You'd have gone to that model template that we created on the 6 historical years, and then you'd have hit Export, Excel, Current Template, and that would have set it to Excel. All right. Now, here's the important part. You'll notice when my Excel loads, that it sent the template for Starbucks to my Excel, right? Now, very important. In the top row of Excel, there's an add-in called Bloomberg. If you do not have that add-in, the data will not export. All right. So if your computer in this lab does not have this Excel add-in loaded for Bloomberg, it'll just error out and you won't be able to export the data. You won't know why. I'm telling you why, because you're missing the add-in. Right. So what is supposed to happen is that to export the data, you have to have Bloomberg open, you have to have Excel open. But the point is, on these machines, there's supposed to be a separate Excel file called Excel with Bloomberg off the start menu, right? What I know from TAs, and 2 of them in the back corner of the room right now, is that apparently only 2 computers have that add-in. Somehow in the IT image that they put on for security reasons, they forgot to put that file on most of those computers. So only 2 computers in this room will let you actually do it correctly. For the other computers, it didn't work. Okay, that's why in the confusion last week, the TAs found a kludge, a workaround, which I'm going to talk about in a second. But regardless, that's why we just gave you the file for Starbucks last week. Right. So right now, the TAs are actually working as I speak to document the kludge and the workaround to how to get around this problem. Okay, because basically without the add-in, it won't work. And you cannot load the add-in to Excel because you don't have administrative rights to these computers. Okay, so just won't let you add the add-in. Okay, so what the TAs figured out last week is working around the administrative security problem. You can open up Excel on one of the lab computers after you open up Bloomberg. Okay, but before you export the data, this is for any data export to Excel. What you would then do is you'd open up Chrome. You'd go to a link that they're going to give you on the list of add-ins. You'll click on the link and it will manually add the link working around administrative security to Excel, and then it'll load the Bloomberg add-in. However, it's one time, so that the second you close that Excel, the add-in's gone, and the next time you open up Excel on a Bloomberg, on a lab computer, that Bloomberg add-in will no longer be there. And in order to export again, you'd have to go through the kludge process and manually put the Excel template back in. Okay, so it's not ideal. Hopefully IT will resolve our problem quickly and put the Excel add-in back on all these machines. But until they do, we will have to use this process. Okay. And again, the TAs are literally working on this right now. We're in the 2 p.m. section. They think they're going to have this done by 3:30 and it will be posted by end of today. Okay. So again, what I'd recommend is you try this, see if you can get your data on your company by Wednesday. And then essentially, if you can't, I will reluctantly give you data on Wednesday, but I don't want to. I think it's better if you get your own data for the company that you're working at, right? But again, try and get this data by Wednesday and make sure that you don't have any problems with the model from that data that you're exporting on any of the companies, right? Kind of clear on what we need to do? All right. Then I have to warn you about a second problem. If you remember, first day of class, I said, first rule of Fight Club, because we don't talk about Fight Club. First rule of 443 is we don't talk about the Bloomberg lab because other people will come in here. Unfortunately, PhD students know about this lab. And every one of these terminals has a monthly data export cap. And as soon as that cap is reached, it will no longer export data for the rest of the month. Now, this does not apply to screenshots. It only applies to data exports. Okay. Now, the good news is today is November 4th, and we're near the beginning of the month, and all the caps reset on November 1st. Unfortunately, the PhD students who do a lot of research know about this lab and know how valuable the Bloomberg is to their research and come in here and suck up all the data and basically, kill the machine for the rest of the month pretty quickly. And they act like locusts. So what they'll do is they'll start on one machine, they'll suck the life out of all of the data, they'll hit the cap, and they'll go to the next machine and just suck all that data up and go to the next machine. So as we go through the month, you might have trouble exporting data, and it's usually the outside in. They don't work in the middle. They like to work on these sides of the room first. So those tend to hit the caps first. We can't prevent anybody from coming into this lab. And I'm just letting you know that they come into the lab. And so by the 15th of the month, it gets harder and harder to export data. You might have to jump around a couple of machines. So you guys are you're going to run into two problems. First problem is you don't have the Excel add-in loaded and it won't export the data correctly. It will error out. Or you did everything correctly and it still errors out because you've hit the data cap and Bloomberg doesn't tell you you've hit the data cap. By the way, the data cap is not on volume of data, it's on dollar value of data. So for example, the data that we export, financial statements, Bloomberg almost doesn't care. It's very low dollar value. We could export that for months and they would never care. Let's say you're trying to do Romanian bonds in 1984. Well, that data Bloomberg considers very valuable, that bond pricing information. So it doesn't take much or option pricing for the last 20 years in Tokyo. Like that gets really expensive really quick and it kills a machine really quickly for the entire month. So it's the dollar value of the data. I'm telling you, the researchers get very high dollar value data. I mean, it's what they're trying to do. It's their papers, their dissertations, it's their research, and they need lots of it. And unfortunately, the Bloomberg data does not go that far with them. So just warning you, we're now competing with that for the rest of the semester. Didn't really affect you in what we did historically because we didn't really export a lot of Excel data, but now we're getting to the point that we're going to have to. So I want to make you aware of that. That also applies to the main lab downstairs. Those machines are toast within a couple of days. So I wouldn't even try to go down there and export data. Right? They're probably already sucked up by today. All right, questions about any of that? All right, so assuming you did this, you have this file. This is the Starbucks exported data file. But here's the good news, bad news about this file. These are not numbers. You can click on this and see this is actually a database formula. Okay. It's a field lookup. Oh, wrong one here. That was previous class. This is one I did in the last class. This one I did in this class. These are not numbers, they're formulas, right? So for example, in the real world, you work on Wall Street, you will spend more time in Excel with the add-in than you will on Bloomberg. Because you can design your file in Excel, and every time you open up Excel, it'll pull data down in real time. So for example, you could build a benchmarking template and just the top fields are just type in the company names. It'll pull all the company's data for benchmarking and give you your packet, including all the graphs and charts, and you're done in 5 minutes. like a lot of what Wall Street models is that way. So they'll just build it all in Excel and then suck data from Bloomberg in real time. It's actually very powerful. The problem is you don't have Bloomberg licenses to take outside the lab and use them on your own personal computers. So you can't do that. So what you have to do every time is once you export the data, since you're going to not have a terminal, right? When you actually open up the file another time in your lab, or the TAs don't have terminals when they're grading in their offices, you have to select the data file you've exported, copy it, paste special values, and turn those formulas into numbers. Now, this file is portable and can be used anywhere. Okay, but it's an extra step you will have to do every time in this class. Step number 2, when you do put this into Excel, Excel's not going to like these long dashes. Okay, now what Bloomberg does, and there's no way around this, is when they have a blank field, they just call it a dash. So it's basically like a zero, but they don't export zeros. They export blanks as long dashes. So we have to turn those into zeros. So step 2, find a long dash, copy it. In Excel, find it, paste it, long dash, and replace them with zeros. For Starbucks, that would have replaced 51 long dashes with 51 zeros. If you don't do that, when you export this to Excel, in our formulas that it refers to that, it'll just error out. You see errors throughout your whole model. So those are 2 important changes you have to make to this file. Turn them into numbers, get rid of the long dashes, and replace it with zeros. Save that file, and that's what you're going to then use to use your reusable model. Okay, that is the file that you were given last week. I got so many versions of the file here. Let me close this one. All right, so last week, this, save. The TAs gave you, for the most part, that file, and it was called SBooks data. So that is the file that I just exported, converted into numbers, turning all the long dashes into zero, right? What you then have to do is you have to take one of the models you previously built, okay? So in this case, I will take Nike. So here was our Nike as is valuation with Nike's data. And what matters is that first model data tab, okay? So this has Nike's historical data, and now I want to do Starbucks. So what I'm going to do is I'm going to file, save as, and I'm going to call my Nike model the SBooks as is. And I am doing this for the video, so after video label on it. Still Nike. Then I'm going to take my Starbucks data export file, select the whole thing, copy it, come in here to what used to be Nike, select the whole worksheet, paste special values, and that will, row by row, column by column, overwrite the data. Now I have my model has Starbucks data. To make sure that there's no problems, go to your CFI, make sure you still have a balancing CFI. All right, that's what I would warn you about for the companies this week. All right, so if you put your data in for AbbVie and the CFI doesn't balance, I'd recommend finding another company. Otherwise, you're going to have to figure out why the CFI doesn't balance and fix it. Okay, and so past Wednesday, that's what you're going to be doing if you have an unbalanced CFI. Right, you can't turn in an unbalanced CFI in this class and get any credit. So make sure the models work. Right. So with that in mind, we're now ready to continue working on Starbucks. Step 2, go back to your model data, now my Starbucks data, look at the last year, right? That's column H. Starbucks just reported 2024 results. Matter of fact, what I found out from previous sections to alert the TAs is it happened sometime last week, right? So a couple of students actually had last reported year of 2023, and most of the students had last reported year of 2024, and it depended on when you did the Starbucks assignment because the data updated in real time in the middle of the week, okay? I tended to do my solution at the end of the week, so I had the 2024 data, but there's several students who had the 2023 data. That's, again, why we take screenshots. right? Because the only way the TAs can grade you, because they're going to look at this file like, why do you have last year's data? That looks like an error. It's because at the time of the valuation, that's what was available, right? So it's a good reason why we do screenshots. So back to this, whatever your last reported year is, then go to your assumptions tab, minus 24, assumptions, type in last reported year 24. So some of you will have 2023, some of you will have 2024, but make sure you make that change anytime you get a new company. Matter of fact, when you do some of these pharmas, most of those farmers are going to end December 31st, which means your last reported year is going to be 2023. Okay. Next, operating cash, we're going to leave alone. We need a WACC. Okay. So this was Nike's WACC. I need Starbucks WACC. Again, what I found out in earlier classes is there's, and this seems scary, but there was about a half point difference in WACC, depending on the day of the week you did the WACC. Like it was really volatile last week for Starbucks. That's actually not too common, right? So at the time of my valuation, my screenshot, Starbucks, where I take screenshots, my Starbucks WACC was 9.1%, but I heard from a few students in the last section, change this to 9.1, that they got 8.6. Okay, so match your screenshot. But remember, you got to change it because that was Nike's data. The next big one is the share count. That's Nike's share count. I need Starbucks share count and the price for Starbucks. That's off your DES. So share count for Starbucks, 1133.2, 1.133 billion. So 1133.2. And the price at the time of my valuation was 99.42. Right. And then we do our EEO and EEO2 screenshots. Down here, this is the forecast for expected revenue, expected EBITDA for Nike. I got to put in the revenue and EBITDA for the next 5 years for Starbucks. Right. Now, I'm just going to be lazy because I don't want to keep typing these numbers in. So in my solution file, I had already done this. So I'm just going to copy the data that I typed in earlier, paste it in here. So now I have the forecasted EBITDA margins for Starbucks for the next 5 years. Right. Then I go to my ratios. And here's what I'll caution you. Remember, I'm using Nike or Costco or whatever I used previously. If I have a hard-coded number for Nike or Costco, it's still here. Right. So, for example, I need to put in a realistic tax rate for Starbucks. That 18.4 for Nike is still there. And so I need to make sure I update that hard-coded number. It's carried over into this model. Okay. So 18.4 was not the right answer. This was screenshot number 5, the guidance. You had to scroll down, but fortunately, Starbucks gave guidance and their out-year guidance was 20%. So that was their forecasted tax rate. Again, put 20% in. If your company doesn't have guidance for the one of the 6 that you just chose, you got to use JP Morgan analyst report. You'll have to source that when you give your answers. Okay. But here's the problem. EBITDA, it's a little bit wider. Right. What's going to matter is this perpetuity period. That's going to be really key to our valuation. And right now, we have an EBITDA margin which just equals the previous year. Right. So 2 things are going to matter. One, let's say we did do Costco. Okay. And let's say our Costco EBITDA margin was 8%. That 8% is going to still be sitting there. And if you forgot that that was there and you didn't change anything, you're going to look at that share price. You're like, something's wrong with my model. I don't understand why I can't get a positive share price. Everything else I put in seemed to be right. And you're going to go to either myself or the TAs. You're like, help me. And what we're going to tell you is, oh, did you change that perpetuity EBITDA margin? Because that was the Costco one. and you forgot to change that to a more representative one for Starbucks. That is a common error that you make in modeling, right? That's why I told you we use yellow cells and minimize areas, but even yellow cell, you might have forgotten you did this. Just make sure that when you typed in a hard-coded number, did you guys get what you needed? Are you good? Okay, thank you. All right, that when you type in a hard-coded number, you remember that that's the previous company's number, and I got to put something in representative for Starbucks. So again, equaling the previous years, what we had said before seemed reasonable. Same thing for this 1-year growth rate for 2030. Okay, equaling the previous year seemed right, single digits. Okay, then we came in here and we solved for our G. Okay, so that was the last step in our process. Tools, goal seek. We're going to set the price to be, was it 99.42 by estimating a G. And that's going to be somewhere around 6%. Okay. And so that's the point. I'm going to tell TA somewhere around 6% plus or minus 0.2 is probably reasonable. But that's also if you had 24 data. If you had the 23 data with the other WAC that was closer to 5.6%, then what you're going to end up with is a lower G that's probably closer to 5.6, 5.5, 5.6. Okay. So that's why your screenshots do matter. Right. But nonetheless, you're going to be somewhere in the 5 to 6% range for your G. Is anybody outside of that range or get something far different than this in your as is? And again, your numbers will be slightly different than mine because of the time and day of the week that you did this valuation. Questions? Yes. What's considered what? What's far? Oh, if you got like 3 or 4 or 8 or 9. That'd be harder to justify putting these types of assumptions in. Here as is. Okay. But his question begs another question, which is what I want to spend the rest of our class on. And I'm giving you a 75% probability that what we're going to do, you're going to have to do next week. And we're going to do a lot of practice on Wednesday. Okay. And it's a variation on his question. How do I know? So this is my, I'm going to turn in solution file. Okay. But how do I know that this G is reasonable? And more particularly, because it's based on my margin, how do I know that this perpetuity EBITDA margin is reasonable? How do I know that 22.3% is reasonable? Because here's what I do know, that under the fourth cornerstone, competitive advantage, things tend to regress to the mean over the long run. Companies don't maintain high returns forever. Companies don't maintain high growth rates forever. That 22.3% is the best Starbucks has ever done for margin. Matter of fact, it's marched up steadily from 2025 to 2029 and 2030. And they're now peaking at this. And we're saying that's the margin forever. And our spidey senses should be going off right now saying that doesn't seem right. Okay. So how do I know what is right? Right. So we're going to do a couple of sanity checks here to help us. Now, to do what I'm about to do, we're going to reach into the fourth section of the class. We haven't gotten there yet. You haven't had the assigned reading yet. You haven't looked at the lecture notes yet. So a little bit is just trust me, but it's coming very soon. We know from key value drivers that key value drivers lead to multiples. A couple of questions on your midterm exam. When we do multiples in the fourth section of the class, price to earnings multiple, EV to EBIT multiples, EV to revenue multiples, all multiples are based on key value drivers, which means all multiples are just an expression of growth and spread. That's all a multiple is. It's just a future growth spread combination. Okay. So here's what we know. And I'm going to jump to lecture 4, which is the fourth section of the class. So I haven't gotten here yet. We're going to get there next couple weeks. But here's the point. This is the formula for the key value drivers. If you rearrange the math, you get the enterprise value to EBIT multiple. So I can actually directly estimate an EV to EBIT multiple by rearranging the key value driver formula. This is the key value driver formula. If I rearrange the math, I get the enterprise value to revenue multiple. The enterprise revenue multiple is just the rearranged KVD. So EV to EBIT is the rearranged KVD. EV to EBITDA is a rearranged formula. EV to revenue is rearranged formula. Price to earnings multiple is the rearranged formula. All four of the formulas start with KVD. What's key to KVD is gross spread. Multiples are just gross spread. You can't actually get a different answer for a multiple than a DCF because the company only has one value, law of one price. So that's the whole point. All the formulas point to the same answer, which means they ought to get the same answer. Therefore, all the formulas are just rearranged math. That's what makes it complex. The concept's actually not that hard. 4 sections of the class, right? But here's what we know in these formulas. When we rearrange the math, the enterprise value to revenue multiple equals your perpetuity EBIT margin times your enterprise value to EBIT multiple. If I take my enterprise value to revenue multiple and I divide by my enterprise value to EBIT multiple, I get my perpetuity margin. So trading multiples actually help us for our as is understand what that EBIT margin needs to be. So I can look at the multiples and I will get them. Now, when we do multiples, forward multiples are better predictors of value than historical multiples. Companies are worth the sum of their future cash flows, not their historical cash flows. So on your EEO screenshots, here are the forward multiples for Starbucks. Forward year 1, forward year 2, forward year 3. Okay, so how does it work? Take PE. Here's the price. Here is forward year 2 EPS. Price divided by EPS. That's your second year PE. Price divided by third year EPS. That's your third year PE. Okay, so Bloomberg calculates them every time you load the screen. Here's the forward earnings. Here's the current price. Here's the forward multiples. Okay, the multiples that matter are 2 and 3. Talk more about why later. Just for now, trust me, 2 and 3 matter more. Okay, so I know 2 things. I know the forward multiples of Starbucks. I know that my EV to revenue divided by EV to EBIT gives me a margin. So what I'm going to ask you to do that you haven't done, but will need to do, go back to your ratios tab and add, so go to the assumptions tab and add this. Cell A17, EV to revenue. Cell A18, EV to EBIT. Cell A19, estimated EBIT margin in perpetuity. For forward year 2, which for Starbucks is 2026. That is the EV to revenue in 2026. So if I go to the EEO, forward year 2, EV to revenue, at the time of my valuation, 3.34. At the time of my valuation, forward year 3, 3.07. So 3.34, 3.07. At the time of my valuation, EV to EBIT off the EEO, forward year 2, 21.44. Forward year 3, 18.81. So Starbucks is trading at 21 times forward year 2 EBIT. Starbucks is trading at almost 19 times forward year 3 EBIT. But I'm going to type in 21.44 and 18.81. If I then divide D17 by D18, my perpetuity margin, 15.6 to 16.3. So I know that in perpetuity, Starbucks EBIT margin needs to be somewhere around 16%. Somewhere between 15.6 and 16.3 is what their perpetuity margins have to be to justify the current stock price and the current trading levels. And if I looked at most analysts' sell-side spreadsheets on Wall Street that did the same thing, they're going to come up with margins close to this. So working backwards for the price, we can estimate what the multiples have to be. So here's the point. What is this number in our spreadsheet? If I go to ratios, it is this row. That's the trading multiples. And this number needs to be around 16. And right now, it's 17.9. It needs to be somewhere between 15.6 and 16.3. And right now, we have it at 17.9. So what this is telling me is this is too high. The market doesn't think they're going to maintain 22% into perpetuity. They know that things regress to the mean. And they think this is going to regress downward so that this gets to 17.9. Let's take them credit for the top of the range, 16.3. How do I do this? I can't change a white cell, break the model. So I change my EBITDA to change that to 16.3. So instead of 22.3, 20.6, 20.7. Somewhere in that range is probably a more realistic EBITDA margin in perpetuity. Yes. Well, we're doing it as is. We're going to come back and talk about the bull and the bear next. Let's start with the as is. Okay. Because remember, with the as is, we're trying to explain the current price. Right. And so using some academic formulas, these are things that are important to the current price. So like I said, right now, what I've had you done so far is like, seems reasonable. Year 5 looks like year 6. And you know, I could have left that way for the rest of the semester. And so I had to make a call. And the call was, do I complicate this thing or do I leave it simple? And I decided, look, if I'm going to be academically doing you a service, I want you to build better models. And this is better. Because if you did this in the real world and we didn't do this process, you'd be directionally correct, but I'd like to be more accurate. And this is a more accurate way of doing it as is, because we need a sanity check to tell us what is reasonable long-term. And the multiples help us understand that. And I'm showing you this. This is pretty advanced stuff and it makes you better. So I'm saying there's a 75% likelihood I want you to do this because I think it actually is better. But it's a little bit more complicated than the simple process we've done so far. But it's more real. Okay. Everybody see what we did so far? Then we recalculate the G. Okay. And when you recalculate the G, rules, goal seek, set my price. We're going to get a lower price at the lower margin to 99.42 by re-estimating the G. Now my G is going to be closer to 6.4. So my G at the higher multiple, which gave me a higher ROIC, needs less growth, was 5.8, 5.9. Now, with a lower margin, lower ROIC, I need more growth to get the same price. My G is more likely to be 6.4. But I'm telling you, the 6.4 G is probably more explanatory of the current share price than the 5.9 G. Questions? A lot in a short period of time. So that's the first thing I need you to do. So we're going to follow a process. At the end, we're going to say, okay, for perpetuity, because perpetuity is key. That perpetuity value is going to be 60, 70, 80, 90% of your share price. So getting the growth and return in perpetuity is the most important. All right. So that's first step. Here's second step. Now I'm going to do off of this, my bull, my bear, my target. Now, just to be clear, yellow line for homework 10, which you've already turned in. We're not grading you on this. I'm just showing it to you after you turn in homework 10. So what we did right before this is how you're going to be graded. Okay. But going forward, more likely for next week's projects, I want you to do this. And on Wednesday in class, lots of practice doing this. Okay. But one more thing as you do. Now we're going to do our bull or bear target off of this revised model. Okay. How do I know when I do a bull or a bear that I'm not being too crazy? Right. Because again, we're just kind of looking at things like, yeah, this seems reasonable. The problem is when you do a DCF, small math changes start to add up. Suddenly, I raise my growth rate, I raise my margin, I lower my tax rate. All seems reasonable to me, but the cumulative effect of all of that is dramatic. And then suddenly, we have a very unreasonable bull or a very unreasonable bear, even though every assumption we made along the way seemed reasonable. How do I make sure that I didn't do that? Okay, I want to show you another sanity check that we're going to start to do. Okay. And this again comes back to the multiples, right? Our model actually calculates multiples. Because if we have a forecasted share price and we have a forecasted net income, we have a PE. If we have a forecasted enterprise value and we have a forecasted EBIT, we got a forecasted enterprise value to EBIT. If we got a forecasted revenue and a forecasted enterprise value, we got a forecasted enterprise value to revenue. So from a process, what we're going to do is we're going to look at what our forecasted pricing creates forecasted multiples. We're going to compare those to the real world. And that's going to be our second sanity check on our model. Okay. So let's talk about what I mean here. Start with enterprise value. That's our estimate on our DCF tab of enterprise value. But I need you to be aware of something. That's Modigliani-Miller. Okay. This is Bloomberg. Go to Starbucks, type in FA, and that is the Bloomberg calculation for enterprise value. Right? In our spreadsheet, we have Modigliani-Miller. Here is the Bloomberg calculation. We're both trying to calculate enterprise value. Let's see what Bloomberg does. We know that enterprise value is interest-bearing debt plus equity. We take all the interest-bearing debt and equity and add it together. Okay, that's enterprise value. What does Bloomberg do? Bloomberg takes equity, market cap, and preferred, and then it takes the total interest-bearing debt. So there's debt plus equity, same as what we do. Then Bloomberg does one additional thing. It subtracts all the cash. See, we don't subtract cash from enterprise value. That's a non-operating item. Okay, but Bloomberg does. Why? This goes back to the 80s when I was a student. I kind of joked about this, but it really was a simpler world, right? When you thought about non-operating items, the biggest non-operating items historically for firms in the 1980s was cash. And most people don't separate out operating and excess. They kind of leave them lumped together. So here's the point. If you take enterprise value and you subtract all of the cash, what do you think that that approximates in Modigliani-Miller? Enterprise value minus all the cash. What do you think that actually approximates? Enterprise value minus cash, and you don't have a lot of other non-operating assets. What do you think that approximates? Operating value. What most people call enterprise value, which are taught in all of your textbooks, total enterprise value. What Bloomberg calculates for total enterprise value is actually closer to what Modigliani-Miller would call operating value. That's why they teach you that enterprise value is the sum of the forecasted free cash flows, because free cash flow equals operating value. And enterprise value minus cash is very close to operating value. So therefore, what they're calling enterprise value, TEV, total enterprise value, is actually closer to what should be called operating value. I'm not saying it's wrong. It's just a shortcut that's been around for 40 years. Right? It's in all the textbooks. And it's in Bloomberg today. So if we take the more clean academic version, which I like, I think it's actually better for valuation, but we take it and we want to kind of compare with Bloomberg, apples and apples, what we're going to do is right here in our valuation tab, we're going to add a BEV. or Bloomberg enterprise value. So we can do an apples and apples comparison. So what's their formula? They take enterprise value, debt and equity, minus all the cash. They don't distinguish between operating and excess. They just subtract all the cash. Again, another shortcut. So that's what we're going to do the same thing here. We're going to take our enterprise value, E19, and we're going to subtract all of the cash. So we're going to go to the balance sheet, subtract out operating and excess. So current cash is G minus G4 and minus G5 off the balance sheet. That's how Bloomberg would estimate Starbucks is enterprise value. And that's more clean than anymore. Everybody with me? So, new worksheet. Multiples. On our new worksheet for multiples in our model, cell B1, EV to EBIT. Cell C1, PE. Keep it simple. Okay. Here is our model. Okay. So right now, EV to EBIT, would it be EV equivalent? Our model is estimating enterprise value, DCF, E19, the new Bloomberg enterprise value, divided by EBIT. We're going to use forward year 2. So income, forward year 2 EBIT. Count 1, 2, that's column I. EBIT, operating income, divided by I-10. Our model at this price is estimating an EV to EBIT of 21.73. Our model at this price, what's the PE? Equals DCF, price, common equity value, divided by income, forward year 2, I net income, I-22. Our model's estimated PE of 24. So an EV to EBIT of 21.73 and a PE of 24.36 is based on a price of 99.42. Based on the forward year earnings. Forward year 2. All right, so here's the deal. Here today, Starbucks RV comp sheets, the very first comp sheet. Here's the industry average PE2, 36. Here's the industry average EV to EBIT in year 2, 23. I know what the averages are. I know what my model's calculating. How far away am I? And I kind of know the range of the industry. For forward year 2, EV to EBIT, Kava 102 is probably a big outlier, but most companies are going to be somewhere between 24 at the low end and probably, even Chipotle starts getting to be more of an outlier at 51, but somewhere between 20 and 50 seems payable. Like the question is, what would a fund actually pay for somebody's earnings? They're usually not going to pay 90 if the industry's at an average of 23. They're probably not going to pay 5. So it's going to be somewhere in this range. Okay. So I think for a PE, average PE in forward year 2 is 36. Kava is an outlier at the low end of the range, 20, high end of the range, 60. That's even getting high. 40, probably Chipotle is more realistic high. So here's the point. I'm doing my bear. Save this. Okay. And in my cocaine enraged bear, which I have to say, I watched it. It was a terrible movie. It was violent. It was stupid. It made no sense, had no plot. I don't even know how it got made. And I watched it. I wasted 2 hours of my life. Okay. But regardless, what if our cell model, our bear model, looks like the cocaine bear? And here's what I mean. We're high at our own supply, right? So the idea is I come in here and say, oh, Starbucks is having trouble in China. And Starbucks, who would fire the new CEO, is having trouble with their pricing. And competition is going to be a little stronger. Dunkin' and McDonald's and others, people don't want to pay $7, $8 for cups of coffee. They're not as successful with food. So it's not going to grow as fast. So I think that their growth rate's going to be 4%. And I don't think that they're going to maintain their high margins, even at 20%. They were at 13% back in 2020. So what if EBITDA margins get much tougher in this much competitive environment, which I've justified in my EIC, and they go down to, let's just call it 16 or 17%. So let's say a 17% EBITDA margin. Well, that gets me down to a share price of $39 a share. And I could justify this in my write-up for every reason that I just gave you. But that $39 share price means these multiples. Do you realistically think that Starbucks is going to trade at 10 times earnings with what people are paying today in the next 12 months? I don't think that's very likely. So that's what I'm saying. I can very easily make some assumptions that look reasonable to me, but when I actually play them out, are actually very unreasonable in the real world. That is too bearish a bear. That bear is not going to hunt, right? And that's the whole point of multiples. The same thing on the bull side. I can go the other way and say, oh, China is going to turn around. People are going to be just as addicted to caffeine there as they are in the US. And in fact, we're going to addict Africa. We're going to addict Latin America. They're going to addict Europe. They're going to get all these prices. They maintain their competitive advantage and they just conquer the world. So what I'm going to do is I'm going to come in here for my bull model and I'm going to say, you know what, that seems to me like a reasonable G. I'm at 6%. So what my G is going to be is I'm going to raise my G to 7.5% versus 6%. And for all the reasons I just mentioned, and I actually do think that they're going to maintain that margin of 22.3% into perpetuity. And that's my bull. And the next thing you know, I have a $200 share price. And at a $200 share price, is that reasonable? Well, potentially. That could be reasonable, but that's near the top end of the range of where the market is outside of outliers. So you could see that as a high end. But let's say I make the exact same assumptions. And I said, no, my growth rate is going to be 8.5. Doesn't seem that much of a difference, 7.5 to 8.5. Well, that turns into a share price of $491 a share. And that gives me those multiples. And when I look at a 93 EV to EBIT, like outside of a broken stock, which is what I would call Kava, no one's going to pay 93 times EBIT for Starbucks in the next 12 months. And so I'm saying that is just completely unreasonable. Yet 7.5 to 8.5, I could probably justify in a paper. So it's just, how do we make sure we're doing reasonable recommendations? Multiples help rein us in. So I've shown you two things today. I've shown you doing the multiples as a sanity check. And I've shown you how to use multiples to help you estimate a perpetuity EBIT margin. That's more reasonable. Those are two things we didn't do so far. 75% likelihood you're doing for next week. We'll practice using this on Wednesday in class. We'll do multiple companies, multiple as is, and the modeling of this to make sure we all can do this. I'm going to give this file as the solution for Starbucks. I'll put it up there. All right. So you're going to have two files. One is what you turned in for Monday. That's going to be the solutions the TAs will grade you against, which again will vary depending on the day of the week you did and what numbers you had for Starbucks. Right. And then this one, which you weren't graded upon, but you will be graded upon in future assignments, which includes the EBITDA margin sanity check and the multiple sanity check around our valuations. Questions about any of that? All right. So again, the TA is finished at the middle of this class. They're going to give basically a write-up on how to export data using that workaround. I am submitting to IT that they need to fix these computers and put the Excel and Bloomberg add-in back into the lab. They probably don't realize that they wiped it out by mistake. But otherwise, good luck on all of this. Did you sign? Oh, did I turn off the attendance sheet? Oops, sorry. Here is the attendance sheet. Make sure you sign the attendance sheet before you leave. I'm going to put it over here on the cabinet, and otherwise I will see everybody on Wednesday.